A Toronto builder launches a $1 billion fund to increase the city's rental stock. This builder is Fitzrovia, and they're backed by $1 billion from a Canadian pension plan. Wow. This is a lot of money pouring into the real estate purpose-built rental space. It's a lot of money. Like, we're talking $1 billion. And it's becoming abundantly clear that the big boy pension fund money is continuing to push forward and build a lot of these purpose-built rental games and moving a ton of their capital into the space in a weird time where I will show you that the asking rents, meaning the list price in Toronto, are down 9.2%. The leased out rents, meaning the leased properties, are now down 10%. As you can see in this chart, they're coming down. That's where the white dotted line is. So what gives? And this is exactly what I'm going to be breaking down for you as a condo investor and how you are going to be impacted. Now, being a condo investor nowadays has such a wide spectrum that I need to put the right frame of mind into what a condo investor is for you first, so that you understand where I'm coming from, because there are different types of condo investors from what I can see. And I would just, generally speaking, bucket up into 3 types. You got your first ones, which are your condo investors who bought before 2019. And these investors are well in their black, they've made money, and they'll likely, sell for a profit if they sell right now, as long as they haven't refinanced their condo in the time they've owned it. And I find a lot of them right now, when I speak to them, are looking to kind of liquidate their property because, again, they also don't think that there's going to be much appreciation in the condos in the next 2 to 3 years or so. And that capital can better be deployed somewhere else, whether it be upgrading their home or a different investment property. That's their thought. Number 2 in the bucket list is people who bought post 2020, and there's a high chance that their properties are worth less than what they paid for it right now because things have zigzagged and they're kind of exactly where we are in 2019 in terms of average price. And depending on the cash flow negative position of these, bucket investor number 2 investors, they're struggling with whether they should hang on for another 5 years and reap, what's clearly coming, the condo shortage, or they liquidate now to, avoid excessive negative cash flow. That's kind of what they're thinking right now. And the biggest dilemma here is whether they can hold on with cash flow negative for that long, being call it 5 years out. And that answer usually just depends on their own personal income. Now, the negative news that you see and hear about the Toronto Condo Market really is in this bucket if number 2 bought pre-construction for 20, 30% more than what the resale value is. And the third bucket is, I would say, the condo investors who are kind of getting back into the market right now. And I'm going to include first-time home buyers in this equation as well. And you saw it with the sales in the last month, where you saw the Toronto condo sales increase about 33%. And we're now clearly moving in a lower mortgage rate environment. And the cash flow numbers, when you look at the chart over here, are slowly starting to break even when you adjust for the principal repayment, like repaying back the equity. So it's making more and more sense for this bucket, number 3, of condo buyers. So as billions of dollars are being flushed into the rental space right now, we have to understand why. And it's always an incentive, right? So the pension funds need to provide a monthly income on an inflation adjusted rate. And that constant flow of income is to pay out the people who have pensions, right? So the pensioners, and that's their main focus. They generally don't buy and sell things like, pre-construction condos to create revenue. They hold on to income generating assets such as rental properties to service a lot of these monthly incomes for the pensioners. And in the scale that they operate at, they look at giant apartment buildings and complexes. And they need to make a certain spread with the capital that they have right now. And if they can't buy it, they'll try to build it. And this is why the spread makes sense now, especially with the fact that people are converting offices into residential and they're not buying the land because they're doing a 100-year lease on this, which means that there's a lot less capital expenditure or CapEx to create this yield for the pensioners. Also, it's kind of like a new product, so it doesn't really fall in the landlord-tenant board for being under rent control because it can also be inflation adjusted. So that's why they're doing this, right? So how does this impact the daily condo investor, whether you're in bucket 1, 2, or 3? Well, it's because there's going to be a ton of additional rental supply coming on the market. And you can already see in this chart that there's about 70,000 condos and like 20,000 apartment units coming online in the next few years. That's going to service the Toronto market, which I would say is quite a lot of supply, but not enough supply that's going to last past that because we have no construction starts. But the condo supply is what I was talking about in the past, where by 2028, it's going to dry up. And we're really going to have to see how much rental stock these pension funds create in those years, call it the 5 years, to dictate how much demand there is on the rental side, come 2028. But what I can tell you with how much inventory is coming to the market in the next 3 years from this chart is that I really don't see rents increasing much more for the time being. Yeah, I just don't. Especially given that the population is going to shrink for the next 2 years because the immigration story, as per our government. Meaning we have less people for the properties that are being completed now. It's just supply and demand. We have too much supply right now. And when we look at telecom registration, this is Bell, like mobility, as an indication of where the population is going, you could kind of already see from last year that like cell phone registrations are like down 40%. This tells us that, we aren't seeing maybe some of these non-permanent residents still come in, or they're actually just leaving because not many people are trying to get a cell phone service right now. So the population may be decreasing faster than Stats Canada can count. So I think that's going to be a problem. So this is why I expect rent for the next few years to be going down, or at the very best, stay the same, like as an aggregate, okay? Now, let me apply this information I'm telling you into the 3 buckets of condo investors and how you should interpret this data. Number 1, if you're a condo investor who bought before 2019, the chance of price appreciation the next 2 years is low, right? Because rents are down, immigration is down, and you don't have that investor demand like we did kind of like pre-2021 and even like somewhat of 2020, given that rents are down, which only means that the inventory that's being out there right now is being absorbed by first-time home buyers, or call it long-term investors who have horizon past 2028. And when inventory stays high, you can expect prices to stagnate, right? Because if you look at this chart over here, which is the chart for months of inventory, which is just a quick ratio of how sales are going, you can see that we're in the yellow kind of bar right now, which is in between 4 and 6 months of inventory, which means it's a balanced market and prices don't move. Unless we go below 4, prices don't go up. Unless we go above 6, prices should be coming down. So I suspect we'll stay kind of in this category for the next little bit. And even with the rate cuts coming, because condos have essentially been like 60% investors as per Stats Can in the last 5 years, and they're all still kind of shocked by this like rate hiking cycle, I don't think they're coming back. So you can choose right now to hold your property, rent it out, and break even on cash flow depending on what your position is, and reap the rewards of appreciation, which is likely to happen in 5 years, or you sell and deploy the capital elsewhere. Bucket number 2, the people who bought post 2019. If you're close to breaking even on your cash flow after mortgage repayment right now, which is kind of a way to fudge numbers, and you don't want to lose money on the investment, like we're talking hundreds of dollars, especially after transaction costs, the obvious answer is you hold on to it, rent it out, and you ride it out until 2028, assuming you can stomach whatever that cash flow negative is with your income, assuming rents don't go up, and it may come down. And if you bought pre-con at 30% over market price, so looking at pre-cons, call it $1,300 price per square foot, it's either you lose money fast or you lose money slow. You lose fast, you basically eject from the market and you take a loss on your deposit, or you choose to lose money slow and maybe you're cash flow negative, $1,000 a month for the next 5 years, which is going to be $72,000 before your investment gets back to the price for you to break even. And remember, the math works like this. If you bought for, say, 30% above what the current market is, so call it $1,300 price per square foot, and the market is $1,000 price per square foot, you need 5 years of 6% growth in a linear way to break even before transaction costs of 5%. So you're losing money slowly anyways. And given the months of inventory chart I showed you, I'll put up here again, I don't think we are getting 5% appreciation, at least in the next year or two. So you're going to need more than 5% appreciation in the latter 3 years of the 5 years. And I'm not optimistic we're going to see 5+% growth until at least 2028. Again, I could be dead wrong, but that's what the numbers are looking like right now. Bucket number 3, you're looking at the condo market right now as a long-term investor, or you're a first-time home buyer looking to own a property and hold it for 5 years before you move to your next one and upgrade. And you can safely start looking now, is what I would say. Given that rates are coming down, the numbers will look better in the short-term future, once the rates continue coming down, depending on when your closing is. Plus, inventory is still high, so you have your selection of units with good layouts and good views and not elbow units with no light, and there's no competition right now, right? So while seller confidence is on the rise because rates are coming down, there are still motivated sellers right now as we kind of head into the holiday market. So people are still in the market right now. They're probably still motivated, right? We still may have that massive delist by December, but until then, still opportunity, right? And if you want to wait it out for a few months until like 2025, you'll be fine. Don't have FOMO. You don't need to jump into it. Just reassess what the inventory level looks like for the condos in March, like before spring market, and you can reassess how much more time you have, right? And if you fall into any one of these 3 investor buckets, right, and you want to talk about your unique situation and what you can do or should do or what options you have depending on which bucket you're in, you could do so by booking a call with me using a link that's on the screen. It's right here. It's www.chatwithzen.com. The link is also in the description below. And this way you can figure out what to really do if you're contemplating about making a move, right? And if you want to learn more about how the market is performing right now, and if you want to include kind of like freehold homes, such as detached homes, semi-detached homes, and also townhomes in the surrounding Greater Toronto area, on top of just like, not condos like I'm showing you this video, you can watch this video right here.